Given the huge amount of U.S. and global central bank easing, it should be no surprise that non-U.S. stocks are now moving up across the board. Chief equity strategist and economist John Blank explains. John, is there more value in these non-U.S. stocks because U.S. stock market valuations are getting too elevated?
Yeah, Terry, what I would tell you is the countries that have successfully managed their way to low virus counts are getting a bid. And so in areas like Europe, where, for example, Germany has done quite well, you should be looking at stocks in Germany, but not actually places like the UK, which have done relatively poorly. So stay away from Brazil, stay away from the UK, and focus on mainland China, places like Germany, South Korea, and Japan for stocks that work outside the US.
So do we run the risk then here with our market of a market correction this summer because of all this?
Very much so, Terry. I mean, we've had a nice long run, and we saw some poor weekly unemployment claims showing some stagnation in the U.S. economy, and that soon or later, the market has to adjust itself to the reality that this isn't going to be as easy as we'd like. So yes, the answer is a market correction is very real, and we should keep it as not the base case, but at least a 30 or 40% chance.
How long do you expect foreign central bank activity to be supportive to these non-U.S. stocks?
For the duration to the end of 2022, Terry, I think the simple answer is the 84 central banks that have eased are going to stay in easing until the Fed doesn't, and the Fed's basically in easing until 2022. That's the answer.
And so what role does the global pandemic play in all this exactly?
Well, basically, Terry, we've got the U.S. as the pariah state in the global economy. And what that means is everybody is going to look at our virus counts. There's a public health minister in any country in the world and say no go to any U.S. travel. So people are not going to come to the United States and are not going to leave the United States. And we're such a critical part of the global economy that is one of the most important headwinds that we're faced with right now is basically the U.S.
Are there any other geopolitical issues affecting these non-U.S. stocks right now, like the U.S.-China tensions?
Of course, the U.S.-China tension story is getting a lot of airplay these days. The trade deal was a bust. Hong Kong is under siege. The Uyghur story is always getting news attention. Now we've got intellectual property, which has been, simmering for quite some time with the FBI looking into hundreds of cases. Now we've got the Houston consulate being shut. And of course, all of this is taking place in front of the election, and the president of the United States is building support from his base with these actions. So trying to separate what is just being done to stoke support in front of an election and what is being done to actually address concerns should be what traders should deal with. And in that sense, it's something you should basically discount to some degree because it is an election-driven phenomenon.
So is that going to call a halt then to our U.S. stock market rally until 2022?
No, it won't. The Fed's still in the game. The 84 central banks are still in the game, and that is the story. As long as the Fed doesn't stop this rally, and nobody else will.
All right. There's also the Q2 earnings season for U.S. S&P 500 companies currently underway. If, bottom line, the data comes in bad as expected, they're going to depress stock valuations here even more. And if it does, they're going to be a renewed value in U.S. stocks?
I think Q2 earnings season, whether it surprises or not, is irrelevant. I think the real issue is whether we get surprises out of the outlooks for 2021 and we learn about potential virus vaccines getting distributed properly. So I'm not a big buyer on any earnings surprise numbers coming out of Q2.
All right, let's take a look at a few stocks on your radar this month in that non-U.S. realm. Thermo Fisher Scientific, UBS Group AG, and Canadian Pacific Railway.
Yeah, let's talk the Thermo Fisher Scientific. This is a name most of you probably don't know. It's $410 a share. I think it's a value score of D. The company makes all kinds of medical instruments. It's about $15 a share in earnings. Just a phenomenal stock for the last 5 or 6 years, but you got to wonder with the momentum going on here whether it's time to sell a stock and not to buy a stock like this. Next one I'll take up is UBS Group. Okay, this is a bank, just to give you an idea of how pessimistic people are about the economy via the banking channel. The UBS Group is $12 a share. That's a value score of A. So you got to ask yourself, which would you rather buy at this point in time? I might actually be a buyer of that stock and not the other. And the final one is Canadian Pacific Railway. This stock, again, much like Thermo Fisher Scientific, has been on a run for years now. It's around $275 a share. So at these levels, I'd wait for a pullback on CP, but value scores of D with CP and with Thermo Fisher Scientific mean seller. I'm a seller, not a buyer. But longer term, if they do pull back, if we do get that correction sometime this summer, those are the names you want to have on your watch list to buy when there is a pullback.
All right, Chief Equity Strategist and Economist John Blank's advice, talking non-U.S. versus U.S. stocks. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.